All right, welcome back, everybody. John Caruso here. Today is September 30th. We're going to do a quick peek in on the market. Of course, today is the last day of Q3. We've got kind of a wild day going on right now. We've got a lot of push and pull, ebb and flow in the indexes. You got the S&P 500 down about 17 points. You got the NASDAQ sitting there at 1797. We've seen about a 200-point range in the NASDAQ here today. We've seen it as high as 14,880, as low as 14,680. And here we are, we're about to cross back through 14,800 right now. Metals markets are reflating a little bit. The metals markets have been absolutely beaten down pretty viciously here over the last couple of weeks. And a lot of that is probably attributed to the strength we've seen here in the U.S. dollar. U.S. dollar seems to have made a pretty meaningful turn here recently in the market. However, I do think the dollar's at a point where it could probably stall here. The rally could stall and we could see some mean reversion back below 94 here in the near term. But I'm looking at this move in the dollar as kind of a shot across the bow that it is very much interested in trading higher in coming months alongside Treasury yields. So that's another story here. Looking at the 10-year yield, we've seen about a 25 basis point move over the last 2 weeks in the 10-year yield up to 152. So the 10-year has broken into a higher trading range. We're going to call it about 1.38 to about right here, about 1.55 in the 10-year yield. So 10-year yield looks like it's in a point where it could stall out here, especially with a lot of the drama that's happening in Washington, D.C. Any anxiety over the debt ceiling in coming sessions could knock the yields back to the downside, and you'll see an uptick in the bond market, which at that point, you want to look at likely positioning on the short side of the bond market going into the end of the year. We do think we are in a period of rising interest rates. I'm not going to give you a year-end target for the 10-year yield, but 1.76 was the year-to-date high. I certainly think that we could challenge that, and that would likely be a pit stop on its way to 2% going into 2022. So putting all that together here, dollar looks like it's immediate term overbought right now. Yields look like they're immediate term overbought right now. If you get a pullback in the U.S. dollar, you're likely getting the bond market or the yields market starts to come in a little bit. You want to be positioning on the short side bonds when that happens. We also, going into the end of the year, like the U.S. small cap index, the Russell 2000, that's one that we're going to be taking a very close look at here in coming sessions. Where we do think U.S. small caps, aka value stocks, could perform a lot better, or outperform, I should say, versus growth stocks alongside a rising interest rate environment. So value tends to do well with interest rates rising. So keep that in mind. That's all I have for you today. I'm going to be out of the office tomorrow, but if you guys want to reach out, if you want to jump on our morning market insight letter, I'd be more than happy to extend you a free 2-month trial. Just reach out to my email, jcaruso@rglfutures.com, and we can extend that to you, no problem. Feel free to reach out once again. I'm John Caruso. We'll see you back here next time. Good luck to everybody.